If you wait till you know everything, it's too late.
Day on Wall Street since the crash of 1987.
The Dow traders are standing there watching in amazement, and I don't blame them.
We're now down 43%.
Almost everything there completely wiped out. In the NASDAQ, everything and more has been completely wiped out.
Let's talk about the speed with which we are watching this market deteriorate.
So I'm going to play you an interview from Warren Buffett. Warren Buffett's one of the most famous investors of all time. He's worth over $200 billion right now. I'm going to play you an interview of him talking about the 2008 financial crisis, because there's a chance that the 2008 financial crisis is about to happen right now in 2024. So we're going to play this interview, and then after the interview is done, I'm going to show you into my $800,000 trading account, and we're going to talk about some of the plays that I have based on this information that Warren Buffett is talking about. So here we go.
1 billion, 2 billion, 3 billion. You can imagine the American economy is an economic train moving down a track that has no ending. And it picks up cargo and passengers as we go along. There's 330 million of us now, and there were only 4 million in 1790. And our farms are incredibly more productive, and we have 75 million houses, and we had a few huts then, and we have great universities and all of these things. So we're just constantly moving more and more cargo and passengers along, and occasionally that train is going to get derailed. In 2008, you had something close to a bubble in home real estate. 50 million people had mortgages roughly at that time out of 75 million homeowners. When that bubble burst, it hit home to probably 40% of the households in the country, these people that had mortgages on their houses. And fear spread in the month of September 2008 at a rate that was like a tsunami.
Who do you hold responsible for that?
Bubbles are always hard to ascertain the originators of it. There really aren't any originators. Everybody got caught in. Some were foolish, some were crooked, some were both. But you had a mass illusion that it could go on forever. You had Wall Street firms participating, you had mortgage originators participating, but you had the public participating. And it was, you know, it was a lot of fun. I mean, it was like Cinderella going to the party. I mean, it was all going to turn to mice and pumpkins at midnight, but nobody wanted to leave until 1 minute to midnight, and the rush for the door couldn't be handled. The U.S. government had to do the right things, not perfect things, but generally the right things, starting in September, and they did a fantastic job, actually, of getting the train back on the tracks. There was still damage for a long period thereafter, but it was really important to have fast action at that time. And we were very fortunate we had the leaders we did. If we'd had people who waited for all the information to be right, or for committees to work, or that sort of thing, it would have been far, far worse. There's people talk about a fog of war, but there's a fog of panic too. And during that panic, you're getting inaccurate information, you're hearing rumors. If you wait till you know everything, it's too late. People today, 10 years later, they're still affected by the crisis, various people in different ways, but they're not as affected as they were in 2009 or 2010.
Has that confidence come back?
Yeah, but it comes back slowly. I can understand why people that lost their houses or lost their jobs or whatever may have happened to them feel that there must be somebody out there that was profiting from this, that did it doing some things that should send them to jail. The people that ran most of the institutions, the big institutions, they got in trouble. I mean, I probably shouldn't name names, but they went away rich. They may have been disgraced to some degree, but they went away rich. So I don't think the incentive system has been improved a lot from what it was 10 years ago. If I knew what the next crisis would look like, it might be a little bit helpful in stopping it. But there will be other crises. There's no way of knowing when you're in a situation like we were in the fall of 2008 or 9, when or precisely how it will end. You know the United States will come back. The factories don't disappear, the farmland doesn't disappear, the skills of the people don't disappear. But you had a system which was going to put them all in an idle position, or could do it, and there's no way of knowing how far it was going to go.
So Warren Buffett was talking about the S&P 500. So the S&P 500 represents roughly 80% of all the economic activity in America. So if we just look at the S&P 500, this is basically a stock chart of how America did. So the S&P 500 index has done roughly 10% per year since it started out. It's been like clockwork. Some years it's up more than 10%, some years it's down more than 10%. but when you average all those years together, it does roughly 10% per year. So let's do a quick example just to show you how much money you could really have if you would just invest into the S&P 500 and you forget about everything else. So we're going to make a single investment of $10,000 and we're going to say you have this money in the S&P 500 for 50 years. So let's say when you're 20 years old, you put $10,000 into the S&P 500. When you're 70 years old, 50 years later, let's see how much money you would have. So 10% is how much money you're going to make per year. And if we scroll down, you're going to have $1.4 million. $1.4 million for making one single investment of $10,000 and you do nothing. You don't listen to the news articles, you don't listen to CNBC, you don't listen to Jim Cramer saying that there's a market crash coming, because you have to understand that CNBC, Yahoo Finance, all these media companies, all they want you to do is look at their content. They want eyes on their videos, they want eyes on their websites, they want eyes on their TV shows. Why? They're media companies. They get paid money from advertising. So when they put all this negative news, all this fear-mongering news out there into the world, they know that it's clickbait and they're going to get you to go look at that article. And if you go look at that article, guess what's along the sides of the articles? There's ads. And guess what? The more people that look at those ads, the more money that CNBC is going to get in ad revenue. That is how they make their money. So people like Jim Cramer, they have a TV show called Mad Money. Guess what he does at the end of every single Mad Money TV show? Is he takes questions from people. So these people are probably fake and they call in and they say, hey Jim, I just want to say thank you. I learned so much from your Action Alerts Plus. I make so much money. This is how Jim breaks it to the audience where he says, oh, I have a service. And if you want to learn how I trade and what stocks I actually hold, go on his website, pay him $100 a month and you can see that stuff. And I actually did that and it worked on me. So I subscribed to Jim Cramer before and I got to see his entire portfolio. And the first question that I asked once I got subscribed was, did you beat the S&P 500 in the long run after fees? They would not tell me, they wouldn't show historical data because the answer was no. So for the typical average Joe investor, if you just invest in the S&P 500 in a low-cost way such as VOO, this is a Vanguard S&P 500 index fund, invest in this, dollar cost average in as you get more money, meaning every time you get paid, you just put more money in, you'll do really good in the long run. So now heading over to my trading account, this is Charles Schwab. So right now my account value is $830,000. I made $7,500 today, and in the last 2 years, I made over $550,000. I started this entire account from zero roughly 5 years ago. The total contributions that I've made to this account is roughly $100,000, so I've absolutely dominated the stock market in the last 5 years. I made way more money than the S&P 500. And the way that I do it and the way that I invest, I do have a lot of money in the S&P 500. I do have a lot of money in the NASDAQ, but I also trade stock options. I use stock options as a way to magnify my returns when I feel like the market is undervalued. That's the million-dollar question. When is the market undervalued? Just like Warren Buffett said in the interview, when is a crash going to happen so I know that I could sell everything on the top and then buy on the bottom? That is the name of the game and it's really hard to do. But in general terms, I feel comfortable valuing the market to know when I should make trades versus not making trades. So this is my trading account right here. It's $764,000. It's lower than the total value of Schwab because I have two other Roth accounts, one for me and one for my wife. So there's money in those accounts. So the total value of Schwab is $830,000, but this account alone is $764,000. So total unrealized gain loss is $276,000. So this cost basis right here is not accurate. So in total, I probably contributed roughly $100,000 to Schwab in total. And then the difference of $100,000 to $800,000, that's all capital gains. That's all money that I made on my money. But the reason why the cost basis is not accurate is because this is only factoring in on the positions that I currently have open right now. So for example, if I bought Apple stock years ago and I doubled up and sold for a profit, I made money, that money went to cash in my account. But then when I take that cash and I go buy shares of Triple Q, for example, my cost basis resets. So this doesn't really factor in accurately what the total cost basis of the account is. So now going back to what Warren Buffett said with the S&P 500, I bought VOO. So right now I have 461 shares of VOO and the market value is roughly $243,000. So let's go back to that compound interest calculator super quick. So if I put $243,000 as my initial investment, I put no more money in than Charles Schwab, I put no more money into the S&P 500, I'm 30 years old right now, so when I'm 70 years old, which is 40 years from right now, estimated interest rate is 10%, that's what the S&P 500 does historically, I'm going to have $13.2 million by doing nothing. When I'm 70 years old, I will probably have $13 million. I'm doing nothing right there. Now that's not even factoring in that I have over $440,000 of Triple Q stock, which Triple Q is the NASDAQ. That's not factoring in any of my Tesla stocks. This is not factoring in my other brokerage accounts because I don't really want to have too much over $500,000 in any brokerage account because the SIPC insurance only covers you up to $500,000. So it's important once you hit 500K to start breaking up your accounts. So that's why I don't contribute any more money to Charles Schwab, because technically speaking, my SIPC insurance, which is similar to FDIC insurance, but for brokerage accounts, it's SIPC and it's $500,000. So right now I technically have exposure from 500K to $764,000. Now with Schwab, they actually have extended SIPC insurance. So that's great. I understand everything what I'm doing with Schwab. I call them all the time. I read all the fine print with them to make sure I feel comfortable that I have over $800,000 with one company being the custodian of my shares. So let's show you the power of investing in the S&P 500 for the long run. So the current price of VOO right now is $526. So if I go over here to cost basis, I click on that, and these are all the times that I bought into the S&P 500. So you could see 1/22 of 2019, I was buying shares right here for $244 per share. But remember, the price right now is $526. So I over doubled my money on those initial shares that I bought, because oftentimes with the stock market, what you think might be expensive today, maybe a year from now, that might look cheap when you look back in retrospect. So maybe when I bought these shares of VOO all the way down here on the bottom in 2019 for $244 a share, maybe it seemed a little bit expensive then, but now look at it. Wouldn't we die to buy shares for $244 a share when they're over $526 a share right now? I mean, let's go look at Triple Q. So the price of Triple Q right now is $485 a share. If we go all the way down to when I started that, $485, look at, I was buying shares in 2019 for $160 per share on Triple Q. I mean, it's totally nuts. I went from $160 per share all the way to $485 per share. I pretty much tripled my money. Now you can see through here, I have a bunch of stock options. So stock options is the way that I add on to my portfolio to make a lot more money. So I have a course that comes out in the middle of October. I'm going to teach you everything that I know about stock options, psychology of money, and the things that actually move the needle to make money in the stock market. The stock market does not have to be complicated, but so many people overcomplicate it. I went from $0 to over $2 million before I was 30 years old. I do put in a crap ton of work studying this stuff, and I'm always a student of my craft. I will never claim I know everything. I always have something to learn. I always want to get better. I always want to be a better investor because I want to help you guys as much as I can. And of course, I want to make myself as much money as I can too in my trading account and my other brokerage accounts that I have open too. So that is why I started this YouTube channel, because I want to share what I've learned with you guys, because a lot of financial advisors and a lot of Wall Street pros, they don't even beat the S&P 500 in the long run after fees. And I'm trying to show you that there's a better way. One, for the average Joe, if you just put it in the S&P 500 and forget about it. But also, if you want to do better than the S&P 500, I can teach you how I personally do stock options and how I make a lot more money in my portfolio with stock options. So for 2024 so far, I've been making roughly $20,000 per month trading stock options, and I feel like I'm doing it in a pretty low risk way. Of course, there's no way that is 100% risk-free. There's always a little bit of risk, but my number one rule with investing is to never get wiped out, and Warren Buffett's number one rule is don't lose money, and his number two rule is don't forget rule number one. So I live on that, and I stand on those principles. So I got a couple links in my video description below. Make sure you check those out. One's for my course, one's for my free stock market blueprint. I also have a Discord if you want to get in on that. And if you made it this far, like, subscribe, and I'll see you guys later.